The article Off-Farm Income, Managing Risk in Young and Beginning Farmers circled around the farm households over the past few years that have relied on off-farm income and how this trend is increasing, especially with young and beginning farmers. The growth within off-farm income has been noticed primarily in the direct-to-consumer markets. Record earnings during the early 2000s and early 2010s created opportunity to bring younger generations back to the family farm to participate in operation or begin their own operation. During this recent boom, record net incomes were recorded, and as a result, there was the ability to sustain and even grow most operations, which was a huge benefit to young, beginning farmers, as the cost to enter the market is quite substantial. But in 2013, when sector profitability peaked the following years after, a moderate income period once again came into play. With lower commodity prices and this trend over moderate prices seem to continue for the foreseeable future. So the trend for increasing off-farm income has come back into play, even in a larger role, not only in the cash grain sector, but also true in other moderate earning agriculture sectors. To sum it up, farm income has shifted from a supplementary income source to an important risk management tool for young and beginning farm households, and the implications of this trend are only positive. As an example, University of Illinois corn, soybean, and wheat crop budgets for 2016 include highly productive cropland in northern and central Illinois. Land that may yield 20% or more above the national average. Considering the current cost of production, budgets show revenues will be high enough to provide a return to land. However, profits will not fully cover the cost of average cash rent. This shortfall affects young farmers in particular, since they tend to rent a larger portion of the acres they farm compared to other age groups, due not only to the high cost of good cropland, but also to the lack of availability and competitiveness in certain land markets. Although cash rents will likely fall given sustained low prices, these adjustments will occur only slowly. It is important to note that all young farmers are beginning farmers, but most beginning farmers are not young farmers. The majority of farmers that are not operating large farms spend the majority of their time in off-farm jobs. This truly emphasizes the importance of availability of off-farm jobs to small producers. Table 1 provides the agriculture definitions of the various groups and respective population numbers from the 2012 Census of Agriculture. It is important to note in reference to the table that there is one principal operator that is self-identified per farm, and the primary occupation is based on where the individual spends the majority of their time. Young is identified as younger than 35, while beginning is based on less than 9 years of experience. Looking at that table, you can see how important off-farm jobs are to the agriculture community, since around 52% of all American farmers spend a higher majority of their time in another occupation. Comparing that to the other demographics, you see some variance. Principal operators who are beginning to see a 63% non-farm occupation, while principal operators who are young hold a non-farm occupation as their major occupation is around 53%. Table 2 shows that nearly 6% of total principal operators who report farming as their primary occupation are less than 35. And this figure has grown by 10% from 2007. This growth from 2007 to 2012 was driven by young people managing sizable operations of sales levels of $250,000 and greater. It's safe to assume that the high incomes from the year prior brought these young farmers into the industry. Those born from the 1980s to early 2000s represents the largest group of American workers and could make up half the workforce within 5 years. Many of the millennials are just beginning their careers, providing agriculture a large potential pool of young people to cultivate and retain in farming. Figure 1 at the top of the screen shows the share of farm households' total income from off-farm sources from 1960 to 2014. The figure shows off-farm income as a percent of farm household income in relation to U.S. net cash farm income. It is very important to note that many farms in the U.S. are very small and rely on off-farm incomes as their major source of income. Looking at figure 1, you can see how substantial off-farm income is to the average American farmer. Even in the boom years of the 1970s and the few years after 2010, off-farm income made up large portions of household income, especially in the 2010s. In 2012, which was a boom year for the agriculture sector, you can see 77% of total income was made up by off-farm income. Figure 2 shows the young principal operator off-farm labor participation. The figure itself explains the much faster annualized growth in average off-farm income expressed in figure 1 as young farmers spend considerably less time on the farm in 2012 as compared to 1992. As technology and management become more vital within the farm industry, the farm business is becoming more complex. The skills needed to become profitable overlap with those skills in demand by non-farm businesses. A recent study found that when farm operators work off-farm, they do tend to acquire a management position. This is true especially to large farms. Wages among these professions are on average higher than any other occupation. Half who hold a position within management often obtain a college degree. The link between managing a successful farming operation and more robust off-farm job opportunities is very attractive to young and beginning farmers. Off-farm income not only serves as an income source, but as a tool of risk management, mostly due to the result of reducing the impact that farm income has on the overall household income. Farm income has always been volatile and will remain to be volatile. Shown in Figure 1 is a graph depicting the volatility different incomes have. Farm income dominates the graph considerably. Off-farm income can stabilize the overall flow of incomes because the off-farm wages are much less volatile than farm wages. In relation to other risk management tools, off-farm income is completely unrelated to other farm factors. Off-farm income is completely unaffected by changes in farm policy or commodity prices, yields, or input costs, making it a key tool in risk management. Looking at farmers who farm as their primary occupation today and have upwards of 400 acres of cropland on average, that corn farmer would have to receive an average payment from previously noted farm-related risk management source of more than $70 per acre every year on that 400 acres to equal the income that can be made by one individual in an off-farm occupation if that individual was to make the average per capita U.S. income. While this payment could realizably given extremely low revenues or yields, it is no way a feasible path for the financial long term. Only revenue and yield declines below a threshold trigger payment. But these thresholds continue to decrease as prices fall below previous years. Farm income risk management tools are still useful and add much needed support in the short run. But in reference to the long term, our farm risk management builds liquidity and net worth, independent of the financial situation of the farm. All farm occupations also add another kind of risk management within the household itself, in the form of life insurance. All farm employment can provide employer-paid or subsidized health insurance. There is a strong positive correlation between the probability of having health insurance and off-farm. Not only has off-farm income helped sustain the farm household during periods of income volatility, but entice young and beginning farmers to enter the market by making credit more obtainable. The market can have very high costs to enter, and while it's also a difficulty for beginner growers to receive capital, this can ultimately make entering the market almost impossible. Though through government policy, a farm credit system began for the purpose of providing sound and constructive credit to young, beginning, and small farms. In 2001, they made 33,000 loans to young farmers. And in 2015, when the young farmer population was smaller, they originated nearly twice the loans for 3 times the amount in 2001. Young farmers' debt has increased from 2007 to 2012, indicating large need for credit. Lenders analyze the ability to repay loans when deciding the details, terms, and amount of a future loan. The lender takes into account all sources of income, including off-farm income. Agriculture analysis usually analyze multiple years into the future to reevaluate the capacity for repayment. Due to volatility of on-farm income, they may sensitize farm earnings to obtain a more normal income projection, though this sensitivity does not usually work in reverse. They are not likely to boost future projections when in low years. They might even view the income of each dollar as stronger value. Off-farm income strengthens all financial aspects of a grower's operation and truly helps sustainability and growth for particularly young growers. It makes capital more readily available and is a viable tool for risk management.